Good morning, everyone. This is Peter Marthy with NYSADA, welcoming all of you to today's presentation on the legal state of today's automotive industry from the perspective of a franchised auto dealer. Presenting the program this morning is well-known dealer advocate and NYSADA partner, Leonard Bellavia of Bellavia Blatt. As part of his presentation, Mr. Bellavia will be focusing on current threats to the dealership model with a special emphasis on the following topics: premature EV facility investment demands, acknowledging the EV future while being transparent to your customers, direct sales and misuse of dealer data by OEMs, and blue sky values: buy, sell, or hold. What's the best decision to make? And there will be more topics as well. Questions can be asked using the question tab on your navigation panel. And there'll be a recorded version of this presentation up on our NYSADA.com website by the end of the day. I now turn the presentation over to Mr. Bellavia. Thank you.
Peter, thank you. Good morning. Good morning, everyone. For those of you who attended the NYSADA convention in the Bahamas, this will seem quite a bit similar. We mixed it up a little bit. There have been some developments, believe it or not, in the 3 weeks that have transpired since the convention. So I'll try and mix it up a bit so you don't hear exactly the same presentation. But as you can see from the title slide, we're talking about essentially factory intrusions into the traditional dealership model, the franchise model, and what it really means for dealers going forward. One of the bullet points, the second to last one, it has become more topical than it even was a few weeks ago, because it seems that auto manufacturers are now going public with the idea of what I consider to be the harshest intrusion on the dealership model, and that is using dealer data that really is the property of a franchise dealer to go out and sell products and services to your customers directly. So I'll spend a little time on that later in the presentation, but that's a new point that we didn't discuss at the convention. But anyway, you know, what we're going to do is go over what has transpired. Obviously, we all know, you know, this has been a tumultuous year and a half. So I'm going to identify the types of things that we've been dealing with throughout the pandemic and since business has resumed, and let you know what I see for the future, at least from my perspective, and why 2022 and the years that follow will be the most important for dealers in terms of trying to protect the value of their dealership, because there's clearly a head-on attack by OEMs to intrude and enjoy the profits that expressly belong to franchise dealers, and what dealers can do about it to make sure that they preserve their legacy. So I'm going to start out by giving you a summary. I took some notes of the things that my office has been dealing with throughout 2020. So I'm going to read from the notes initially, and then I'll elaborate on what I think the significance of each of these things are a little bit later on. And I think the first slide is probably appropriate as a backdrop for this, because I'm sure this reflects the current state of affairs at most dealerships. So let me go through what we've been dealing with for the past, I'd say, year and a half, and then I'll kind of segue into how this relates to the future. So the types of calls we were getting over the past year or so from franchised dealers, not only in New York, but across the country, are as follows. Should I sign participation agreements with GM and Hyundai? Should I accept the Cadillac buyout proposal? Should I invest in the EV, the battery electric vehicle infrastructure, and when should I do that? Must I subscribe to digital factory retail software programs? Can Volvo sell electric vehicles and treat my dealership as a glorified delivery center? That'll be a big topic of discussion. Can Ford actually sell the Mustang E-Mach online and appraise trade-ins sight unseen and expect dealers to be bound by those trade-in values? That's pretty amazing that we're talking about something like that. Can my factory control my website, dealer and customer data, and have an open door into my DMS system? there's been some recent litigation about that topic, which we'll touch upon. Can Honda compete with my CPO program by leasing used vehicles directly to consumers? That's a pilot program that Chrysler launched down south. I'm sorry, that Honda launched down south. Is the direct selling, no dealer model of Tesla, Rivian, and Lucid, and others a threat to the franchise dealer model? Are dealers really rushing to market to sell their dealerships to public and large privates? So there's going to be a slide at the end about the buy-sell activity and what's really happening. And our buyers really paying record multiples on 2021 profits. 2021 profits clearly are distorted. It's a one-off, so how does that play into the valuation of blue sky values? So having spent all of 2021 dealing with these issues and studying them and industry headlines for dealers, I can, I suppose, report to you, since the title of this presentation is a state of the industry report, at least from my perspective, and I know from other dealer attorneys that I speak to on a fairly frequent basis. Let me go through my conclusions in my report. The EV transition may be being oversold or at least prematurely implemented by the OEMs and the federal government. Just as autonomous vehicles and ride sharing and OEM subscriptions have had false starts and have become largely irrelevant in many respects, so too has digital retailing. And what I mean by digital retailing, I don't mean shopping on the internet. I mean what has become known as touchless sales, where the customer doesn't even set foot in your dealership facility. So there's been very little consumer buy-in. Studies have shown less than 5% of consumers are totally against even entering a dealership showroom. Next one is each one of the factory initiatives that I mentioned at the outset of this violate state franchise laws and can be legally stopped. And I'll get into how that can be implemented. Direct factory sales that relate to EV startups only, that's Lucid and Rivian and so forth, in my opinion, do not pose a meaningful threat to the franchise system, and I'll explain why. Vroom and Carvana, those frustrating advertisements, are not a threat to the used car space, as franchise dealers are replicating the model to compete with them for the small percentage of those type of buyers who never want to visit a dealership. So dealerships, as they have done for decades, are finding that it's not that difficult to compete with companies like Vroom and Carvana. The dealer franchise model is here to stay, as OEMs do not have the managerial bandwidth to develop a dealer alternative, and they just aren't good at retailing vehicles. Footnote to that observation is that the franchise model is here to stay only if dealers fight for it. Dealers and dealer associations, if they align themselves, because there is a battle ahead, more now than I think I've ever experienced in over 30 years of representing dealers. I think it's incumbent upon dealers to make sure that they invoke the protections that they have, and every single state has very powerful franchise law provisions that prohibit most of the manufacturer initiatives that we'll be talking about. So it's really a question of whether or not dealers and dealer associations have the appetite to push back and make sure that their rights are protected. And finally, dealers and dealer associations, and this ties in with what I just said, are insurmountable in terms of the political legislative strength that they have, provided that dealers remain active and are willing to challenge factory intrusions. All right, so let's start out with the initial topic, are EVs and the EV transition being oversold. Now, let me make clear at the outset that I'm not suggesting that EVs are not on the way. The EVs are coming. The question is when, to what extent dealers need to prepare now versus later, and is all of the hype, and there's hype every single day. The question is, from a dealer's perspective, how do you sift through and reduce to the most meaningful terms how real it is and how quickly and to what extent dealers need to prepare their facilities and their business model for EVs. Keeping in mind that the points that are on this particular slide, look at the bottom first, because I think this captures it. Fire, aim, ready. I don't want to, I'm preaching to the choir, because you all know as franchise dealers a lot more than any of the pundits out there. So a lot of this will resonate with you. Some of this has to do, so I'm playing devil's advocate. Keep in mind, we don't want to, as a group, when I say we, I mean pejoratively, we as dealers, we don't want to stiff arm the advent of EVs, because that will lead to legislative initiatives to have EV manufacturers sell directly to consumers. So if the attitude is franchise dealers are not willing to embrace change, that's a bit self-defeating. So we have to speak, I'm going to speak transparently about what I think is going on. That doesn't mean that I think that there should be a rebellion against the introduction of EV technology. It's coming, but we want to draw a balance between not putting dealer franchise model at risk, while at the same time not overspending or over preparing, because you'll find out from the data that it's still way off. So I'm going to play devil's advocate. So is EV a technology whose time has come, or is it a product of a political or cultural movement? And just going through some of these points, automaker imaging, it's all automakers are throwing their hat in the ring. Obviously, Toyota just announced it, I think yesterday or the day before, that they're being a little more proactive. Toyota dealers will acknowledge that Toyota has been seemingly putting their money on hydrogen cell technology, not totally rejecting EVs. But an interesting question is whether Toyota's headlines that Lexus is going to be all electric by 2035 and that many models will be introduced in the Toyota line by 2030 is real, or is it just a political statement such that it doesn't look like it's behind the curve? So automaker imaging is important, because ultimately when EVs are dominating the market, whether that's 10 or 20 or 30 years from now, they want to precondition consumers, and that's the bottom bullet point here, preconditioning consumers so they're more willing to embrace the technology. So some of this is more image than it is real. Then there's regulatory pressure, right? The government is doing all it can, even threatening that internal combustion engines will become extinct by legislative initiative by 2035. Now, sounds like a pretty glamorous headline, but if a Republican administration comes into power, anything could happen. That could all be scrapped. So we're just talking concepts. So I just want dealers to understand that when they read these headlines, it doesn't mean that you need to go out and spend a lot of money reconditioning or renovating your facilities to accommodate some of the special tools and equipment. Then there's the pretextual objectives. What do I mean by that? About a year ago, as an example, Cadillac wanted dealers to commit. Back then, this is 10, 15 years out, they wanted dealers to commit that they were willing to invest immediately in EV facility upgrades or accept buyouts. So was that a genuine initiative to try and get dealers in place for the EV revolution, or was it a pretextual objective to get rid of the smaller Cadillac dealers that GM has been trying to remove from the landscape, so to speak, for many years now? So the issue is it being oversold, and why is this relevant? I'm not trying to just engage dealers. You're more of experts on this than I am. The question really boils down to, should you be signing these participation agreements and investing $200,000 to $500,000 on renovating your facility here in 2021 or early 2022 for a market share that won't exist for at least 10 years? And let me get into that whole market share question. Keep in mind, before we get into this interesting statistic, ultimately it will be dealers and consumers that determine the future of EV battery-operated vehicles, electric vehicles. It's not government bureaucrats. It's not CEOs of the auto manufacturer. Ultimately, it will be consumers that decide whether they are willing to, unless it's forced upon them by the government. And there's a lot of, I'm not going to get into a political discussion, But to the extent that the consuming public totally will reject EVs for the reasons that we all know about, then it won't be mandated. So the question really is, what is the projected EV market in the US? So I find this slide to be very compelling. Again, I'm not just raising this for the sake of discussing, future EV. It's really about what you need to be doing to prepare and acquiesce to some of the manufacturer demands. So right now, I find this interesting. When headlines say EV market share will triple by 2025, that sounds like it's coming down the tracks at a roaring speed, but it's tripling to 4.9% market share. So it's less than 1.7% now. That's minuscule. It's a minuscule market share. Now, the next bullet point I think is pretty compelling. IHS is a data research provider that every faction in the automotive industry relies on. They own Carfax. They're deeply seated in the automotive space, and they do data studies on a regular basis, and they're relied upon as authoritative in the industry. So the upshot of that is by the year 2030, so 9 years from now, 87% of new cars sold will still have an internal combustion engine. Stated differently, by the year 2030, 9 out of 10 vehicles you sell will still be internal combustion engine vehicles. Now, one footnote to this slide is about a year old, and since the Biden administration came in, there have been some changes, and IHS modified its projections, and that's primarily because the U.S. rejoined the Paris Accord, and also there's been some new regulatory mandates that have come down in terms of fuel efficiency. So the revised figures here are that by the year 2030, 7.5 out of 10 vehicles sold, instead of 9 out of 10, 7.5 out of 10 will still be ICE vehicles, internal combustion engine vehicles. So this puts it all into perspective, and it makes you wonder why companies like GM and others are asking dealers to sign participation agreements and invest several $100,000s now. So kind of getting dressed up for the prom, 11 months in advance. Here's some interesting statistics. Audi, Hyundai, Mercedes-Benz, just by way of example. Audi has announced that it won't be until the year 2040 that 90% of its vehicles manufactured will be EV vehicles. Hyundai, 78% by the year 2040. I mean, we're in an industry where projections are made on a monthly basis. So the notion that we're going to project 20 years out is ludicrous. So what does that really say about the true confidence level that these major manufacturers have in terms of what the market is willing to accept with EVs? Mercedes-Benz has announced that it won't be until the year 2039 that 100% of its vehicle manufactured will be EVs. Conversely, Volvo and Caddy have said that it will be sooner than that. It'll be 2030, 9 years out, that 100% of its vehicles manufactured will be EVs. So it puts dealers in a particular state of quandary because you're asked to invest now. And here's something that I think I hope Patrick Anderson, who's a colleague and a friend of mine, doesn't mind. I'm sure he doesn't. That I'm going to rely in the next few minutes on a study that he prepared that was just released about a month ago at a Bar Association conference for attorneys that specialize in representing auto dealers. I attended. By the way, Patrick Anderson of the Anderson Economic Group is someone well known to New York dealers because I recommended I think it was about 8 or 9 years ago that NYSADA engage Anderson Economic Group when the litigation was pending about the Beck Chevrolet case, wherein manufacturers were seeking to terminate dealers based upon statewide sales performance metrics. And what we asked Anderson to do was break out the state of New York into 5 different market areas. So they did a market data study for New York so that dealers statewide could guard against or fight back against perceived deficiencies in their sales performance based on statewide metrics. So Anderson Economic Group is considered to be an authoritative expert in the automotive industry. They've done some landmark studies for the industry. So the reason I bring this up is because this study, and this is an invaluable tool for any dealer who is being called upon as being deficient in not signing up for these EV programs. And to reduce to its simplest terms, the Anderson study has demonstrated, or dispelled the myth, I should say, that EVs are much less expensive to operate each year for consumers. The bottom line conclusion of this, this is a report that I'm going to make sure is available to dealers across the state. Anybody on this webinar, I'll be happy to send a copy of this report. I think that it will be immensely helpful for any dealer who is combating or unwilling to acquiesce to manufacturer demands. Essentially, what this report says is that it is more expensive to operate a battery vehicle than it is an internal combustion engine. So let me just go through a couple of the points, and I hope Patrick doesn't mind that I'm relying on his study. Here's one very interesting. Before I get into the details of the report, this study is considered, at least in my opinion, and some of the legal experts that were at that conference, to be a bombshell report. Yet, of the two major publications that report on automotive industry important topics, Detroit Free Press was the only one of the two that reported on this study right after it was released. This article is dated October 21st, 2021, almost a month and a half ago. Automotive, this is just an observation. Automotive News opted not to report on the results of this study. I found that very interesting, and the question is, and this is a rhetorical question, why didn't Automotive News want dealers to know that, according to this particular expert, ICE vehicles are less expensive to operate than EVs? All right, getting on to some of the statistics here. Again, this slide, this is from Anderson Economic Group's report. I have a few slides from their report. It's not a typo. Right now, and this is post-COVID, you can see the shaded blue brings us to the second quarter, the middle of 2021. Electric vehicles as a share of total vehicle unit sales is only 2.5%. Keep in mind, this includes Tesla. So there's a long way to go before dealers really have to feel compelled to buy in. So what's the takeaway from this? Again, from the Anderson report, the market is changing very slowly, and AEG's research indicates a strong likelihood of EV adoption in only certain markets, and those markets are, and California is a good example, right, where Tesla is very popular, wealthy metro areas with strong EV infrastructure. And for other markets, the adoption will be slower, certainly rural areas, areas with weak EV infrastructure, and areas with lower incomes. I don't want to spend too much time explaining why, because my audience is franchise dealers, so you know better than anyone why the public might be slow, especially in a market area that doesn't fit, the top bullet point, wealthy metro areas. So it may be that a lot of the buzz here relates to metro areas and certainly not rural areas with a weak EV infrastructure. Here, new vehicle dealers should think carefully about their local market. They must balance automaker investments or required investments against consumers' limited demands for EVs. There's a serious mismatch for dealers located in most markets where the EV push does not match local market demand. All right, know your market, obviously. I'll get a little bit into some of the issues because I think it's worth repeating some of the things that you deal with on a daily basis. Do not assume your customers will jump to buy EVs in droves. So that might be a tall order because you're besieged with articles weekly in the automotive news. You watch TV and you see announcements every day about companies spending billions and billions of dollars in preparation for EVs. But here's the reality that a lot of these bureaucrats, I'm going to get into an article that appeared in the automotive news recently, I think, to drive home this point. A lot of C-level and higher executives at these auto manufacturers still don't seem to want to embrace what you all know, which is consumers have what's called range anxiety with respect to EVs. Most consumers don't have garages. You know, the classic profile of a consumer is drives home into his garage and plugs in the EV. Well, most of your customers don't have that luxury, especially if your market area is more urban in nature. Charging stations. No one's talked about some of the realities. They talk about, well, it'll take 30 minutes or 35 minutes to charge a vehicle at a public charging station. But that presumes that when you pull up to the charging station, there aren't one or more cars ahead of you. So imagine having to wait an hour and a half or more to get your car charged. How will your customers embrace that? There's already been discussion about how often these charging stations are broken. Again, I don't want to get too deep into this because these are issues that you know better than I. These vehicles right now are too expensive for most consumers. They have lower resale value because once the vehicle is old, there's only so much time left before the battery needs to be replaced. The batteries cost at least $5,000, so that has a negative impact on trade-ins and so forth. So there's a whole host of reasons why dealers should be cautious. Again, these are things that are useful in case you want to rebut a manufacturer's demand that you refurbish your facility. This slide, again, nothing you don't already know about being cautious about OEM demands, but look at point B here. For sales performance assessments, carefully analyze local market demand and the availability of EV charging stations. So that's important because to the extent later on that your dealership is being cited for being deficient with respect to sales and service of EV vehicles, this type of data in a report like this is critical in making sure that you're not falsely charged with being deficient under your dealer agreement. Clearly document and communicate with the OEM about your market findings. All right, so let's talk about what I consider to be the most critical topic right now facing dealers, and that is intrusion into sales by the manufacturers. You know, I've been preaching to dealers now for over 30 years about making sure that you're aware of your rights under the state franchise law in the state that you operate or states that you operate. I don't think there's ever been a time where I'm being more emphatic about the need for dealers to know what their rights are, because manufacturers know that most of the time dealers, even armed with the best state statute protections, don't usually implement them. No one wants to get into a battle with manufacturers. However, because manufacturers are doing some of these things on a nationwide basis, it doesn't really require dealers to, for example, sue the manufacturer. It's such a broad application, a sweeping violation of just about every state's franchise laws, that there are things that dealers and dealer associations can do to push back. And the risk of not doing so is that 10 years from now, you may have a franchise agreement. I mean, we all hear about buy-sells each day that are occurring where the valuations of the dealerships are at all-time highs. Well, fast forward 10 years, if all of the things that you read about in the automotive news that manufacturers are seeking to put into place, your dealership will have literally no value if each one of these initiatives actually occur. Use of dealer data by OEMs. This has become the most significant topic, in my opinion, that confronts dealers. And we're going to get into I prepared this slide before this week's automotive news came out. And on the front page of the automotive news is an article about, I'm sure many of you have read it already, and some of you will be getting it in today's mail. Take a look at the bottom of this week's automotive news. Read the article about automakers' intentions of using dealer data to sell directly to your customers aftermarket technology related services. All right, so I'm going to spend some time talking about that when we get to the article that's in this week's automotive news. Price setting by OEMs. Just think Hummer, Ford, and Volvo. They're dictating the resale price of vehicles directly to your consumers. Yet New York in particular, and just about every state that I know of, has a provision in their state franchise law that says it shall be unlawful, I'm reading now from New York's as an example, it shall be unlawful for any franchisor, notwithstanding the terms of any franchise contract, to establish or attempt to establish the actual resale price. But isn't that exactly what Hummer, Ford, and Volvo, and others, I'm just using these as an example, are doing? They're allowing your customers to go on the manufacturer website. And Ford is a glaring example because not only are they setting the retail price, but they're appraising trade-ins remotely and mandating that the dealers honor the trade-in price, sight unseen. If that isn't a glaring violation of the franchise law, I don't know what is. Direct selling of EVs by OEMs. That really, I'm talking there direct selling by the legacy manufacturers, not Rivian and Lordstown and the new EV. Those aren't, I think, a real threat to the franchise system because those are potentially bit players. I don't think that's as much of a threat as your OEM, the legacy manufacturers, directly selling to your customers. I talked about the trade-in allowances with respect to Ford. So some of the things that OEMs are proposing to sell directly are things like through software, heated seats, heated steering wheel, cruise control, automated driving functionality, things like that. And I'll get to that in a second when we get to this week's article. So selling, take a look at the red print. All of the things that you're being told about that you have to adhere to under these new programs by your manufacturer are all prohibited. This slide is prepared for New York dealers, but it applies to dealers all over the country, all prohibited under the New York Franchise Dealer Act. So what to do about it? We'll discuss that later. All right, so there was an article a couple of weeks ago in the Automotive News. I can't seem to advance the slide, Peter, so if you can help me get to the next slide, that would be great.
Yep, we're working on it. Hang on.
All right. So let me just start by saying on December 6th, Automotive News had an article that was entitled, there it is, Global Execs, Big Retail Changes Coming. This was pretty, when you read it, obviously it's a little concerning, but when you get down into the minutia, it's kind of comical. And what I mean by that is there was a study done by a major accounting firm, KMPG, where they surveyed well over 1,000 mid to very high level OEM executives about expected changes in the retail space for franchise dealers. And here's some of their conclusions. By 2030, half say 60% of sales will be direct. Only 40% of those sales would be through dealers. Just imagine, that's 9 years from now. That's pretty frightening. Subscription programs will compete. I kind of chuckled at that because we all know that subscription programs have had several false starts by now and have kind of gone by the boards along with automated driving and ride sharing and some other initiatives. And then switching over to EVs, the EV part of the survey, they say that by 2030, 52% of worldwide market share will be for EV vehicles. Think about that compared to what the IHS study, which said by the year 2030, 8 out of 10 vehicles sold will still be ICE. But the last bullet point, and by the way, before I get to it, the point I'm trying to make here is, and we've joked around in the past that automotive executives at these OEMs, most of them have never sold a car, have never spent time in a dealership, and clients of mine have said it should be a mandatory requirement for an OEM executive to at least spend 6 months on the showroom floor selling vehicles. So here, as a general statement, 1,000 executives responded to the survey. How many of them actually have ever sold a car or interfaced directly with a retail customer? So now to the last bullet point on the bottom right, the variance of opinions as to how much market share EVs will enjoy by the year 2030 ranged from 5% market share to 90% market share. So the so-called people running the automotive companies have no consensus as to what really is to be expected over the next 9 to 10 years. So if the so-called people running the auto industry have no clue, then why should you be spending $300,000 to $500,000 in 2021? That's money that I say would be better earmarked for your kids' college or your grandchildren's college tuition than to buy a forklift and charging stations and expand the size of your bays for something that may not be coming to the extent that everyone's promoted. Next slide. America, this is an article from Bloomberg, obviously an authoritative source, or at least reliable. Americans return to car dealers, thwarting expected shift online. So there again, a lot of the things that were in that questionnaire related to direct selling to consumers, and yet there's credible evidence that that's not really occurring. And keep in mind the touchless phenomenon of, the Carvana type trailer and Vroom trailer, although, that's used cars, but the illustration is the same. How many people really want to buy a car sight unseen without even stepping foot into the dealership? We know from the studies that we've looked at, it's less than 5%. All right, next slide. This is the article that appeared this week in Automotive News, and I perceive this to be really the biggest threat to dealers. And what it says is that the major auto manufacturers are putting together initiatives, projects. They've even named them. GM and Chrysler and Ford and others have identified, their model will look like this. The cars that they send to dealers will be skeletons or bare bones vehicles. And then, let's assume you get MSRP, because that's really what's happening now. I mean, it's not cost plus anymore. It seems to be how much over MSRP. But let's just assume you're selling vehicles at MSRP, selling and leasing. Well, to the extent that all of the popular options that consumers want are not provided now, and all that you're going to get is a bare bones vehicle, as cheap as the auto manufacturers can make them, then your margins are going to be suppressed. And what happens after the sale, take a look. This is just an excerpt from the article. The second line, the second column at the end, General Motors projects up to $25 billion in annual revenue by 2030, and Stellantis began a push to bring in $23 billion a year from such offerings by the year 2030, more than 50 times what it gets from the meager options available today. So where is all that revenue coming from? That's, in my view, that's a global pickpocketing dealers. These are all the revenues that are now going into your treasuries. So auto manufacturers are seeking to basically sell vehicles directly. Now, there are state statutes that say that automotive manufacturers are not allowed to sell vehicles, every state has this, except to franchise dealers. So is this an end run around that? So they're going to give you 4 wheels and a battery-powered engine, and everything else is sold by the manufacturer. So what to do? What to do about something like this? If every dealer came into my office or another attorney's office that specializes in dealership matters, I would say there should be a mandatory injunction issued against this type of program being rolled out over the next 9 years, because you're going to be left with very low margins, and the manufacturer is going to be making all the profits. So this is a real and present danger. I urge everyone to read this article when you get your copy of the Automotive News, and confer with your state dealer association, because this is Armageddon in my view, and now is the time to do something about it. And manufacturers will hope that dealers do nothing, because then they'll just gain more and more momentum. So this is a call to action, in my opinion. All right, next slide. All right, let's jump to buy-sell activity. There's, I think every single day there's an article about either a public or a large private equity group buying another group. So there's clearly a lot of buy-sell activity. I can tell you, I know my office is very busy with it, and colleagues that I deal with, other lawyers have told me they're busy. But I just want to dispel a couple of notions here, and that is that dealers are going to be able to get 10 times their net profits from years 2020 and 2021. And I say this affectionately because I know most of the brokers out there. I do business with them, so their job is to get listings and sell dealerships for the highest price possible. So sometimes you hear over and over about some of these blue sky values, but understand, at least from my perspective as representing buyers and sellers, most buyers, and this particularly in this market, are pretty sophisticated, and they're not going to use 2020 and 2021 net profits as the benchmark for applying a multiple. So if your dealership made $5 million in 2021, it doesn't mean you can expect to collect 10 times that, $50 million at a closing table. You're probably going to be asked to present financials from 2019, 2018, and so forth, or sophisticated buyers will kind of neutralize your financial statement based upon realistic numbers going forward. So I say that simply because to the extent you're going to prematurely put your dealership on the market, just be realistic about what you can expect, because buyers are out there, and I think the net result of this activity, or what's happened, the takeaway is that if you were getting 4 times multiples in prior years, maybe you're going to get 5 or 6 times now during this period. However, it's not going to be based on 20 and 21 profits. So be a little more conservative. The one thing I'll say on this graph, it says the comparison between 2021 and 2020, sales are up by 27%, even though it talks about first half. I look with a somewhat critical eye when anyone compares activity to year 2020. 2020 was the COVID pandemic, and nobody should be using that as a baseline or a predicate or a benchmark, simply because buy-sells couldn't even have been processed during 2020. So that's a one-off year. So if you take a look at the traditional number of completed dealership transactions since 2015, yes, it's a little more if you double those numbers, because these are half-year numbers. So it's still in line. So it's not as though buyers are racing to buy dealerships. Sure, there's plenty of buyers, and there's more buyers than sellers, but I think the next slide kind of illustrates where I'm going with this point. And that is whether you should sell your dealership or hold on to it. And again, I'm not demeaning brokers when I use that term broker puffery. What I'm saying is that brokers are doing their job, and they're doing it well, and they're trying to convince dealers and now is the time to sell, because buyers are paying higher multiples, and it's doubtful what the future is going to bring with respect to EV vehicles, manufacturer intrusion on the traditional franchise dealer network. So all valid points. On the other hand, what I've told my clients is there's another way to look at this. Your dealerships are making record profits, so enjoy it, continue with it, figure out a way to keep it going. Will the paradigm that you're enjoying now, where you're getting list price or more, continue? Well, and you'll be selling ordered vehicles and inventorying less and not having floor plan charges and advertising expenses and so forth. So maybe it won't continue the way it is now, but there'll be some takeaways that I'm sure that both manufacturers and dealers will implement going forward that will make your dealerships continuously profitable, more profitable than pre-pandemic. So why not hold? So unless you have disability or health-related issues, or you're in your 80s or 90s and ready to retire, keep in mind dealerships, unlike certain other career paths, don't require personal services. You're not a professional athlete, you're not a master chef in a restaurant, not a singer or an entertainer where you need to be the one driving your income. You can, especially with technology, and I've seen many clients do this, you can remotely operate your dealership. So to the extent you do want to retire or partially retire, you can still run the dealership. So the trend I've seen, what I'm leading to is identify a potential partner. There are plenty of people in their late 20s to mid 40s that have huge amounts of talent but don't have the capital. Well, take a page from the medical profession or the accounting profession or legal profession. It's not uncommon that we bring in partners to continue the succession. So this notion that you need to sell so that you can collect all this money and then retire, well, that's one path. And that's a path that many people are following, but that's not the only path, especially when profitability is at the highest level. Invest in younger, talented people. They're out there. They would love to be dealers, but because of the blue sky values, they can, and the trading value of dealerships, they can never be a dealer principal. But that's to your benefit if you're a dealer principal. So find somebody to help you, train them, pay them very well. Again, page from medical practices and legal practices. Bring in people that can help you perpetuate what you've built. Now, the brokers on this call are not going to be happy with this, and I'm not saying don't sell. Someday we all have to sell, but it doesn't mean that you're going to miss opportunities if you don't jump on the seller's bandwagon now. To the contrary, there's a school of thought that says hold and bring in key people, pay them well. It's a long time process, and then maybe over time figure out an exit strategy. But I tell my clients, don't feel compelled if you were thinking of retiring in 5 years that you should retire now. Enjoy the profits, because even if you got a great blue sky number of 10 or 15 million dollars, you could probably make that in spades over the next 5 years if you put in place an intelligent succession plan. So Peter, I know we're at 10 minutes up and we wanted to save time for questions, so we covered a lot. So I'd be happy to answer any questions that we can go to our next slide, because that's our questions and answers slide.
Yeah, thanks. Thanks, Len. We do have several questions, or a couple questions. I saw in view of your what you think is the best suggestion as far as the acquiring perhaps suggesting the alternate path of acquiring a partner or something along those lines. Do you see, though, nonetheless, the current activity continuing on into 2022 in terms of acquisition, dealership acquisition, sales, that sort of thing?
Yes, I do. I think there's a lot of people outside the auto industry that are seeing the ROI potential. There's a human resources problem. In a way that's good for sellers, because sellers are always concerned that a buyer might come in and displace their employees. And there's a financial and emotional attachment in the buy-sell context, where sellers want to identify buyers that are not going to just come in and disrupt and displace people that they've come to know and care about for 30 years. So I do think that there's going to be a continuation of bigger companies, some of the bigger privates and publics that are going to be targeting dealerships all over the country. I mean, I get calls all the time from some of these big, the top 5, trying to identify potential sellers. So I don't think that's going to subside. I think the sellers are in a good position now, because although they can't ask for more than the dealership is worth, they'll get more than they could 3 years ago. So I just bring it up in the sense that there's another avenue that dealers can pursue to be just as profitable as sellers can be. But I don't think buy-sells are going to slow down. I would say over the next couple of years, let's not forget, a lot of the things I spent time talking about pose severe threats to the franchise model. So there are dealers that are taking those threats seriously and saying, I want to get out now. You have two factions: the ones that want to get out now because they don't like what they see in terms of intrusion on the dealership model, and those that feel that there's enough protection in the state statutes that they can rely on their state, local, and national dealer associations to fight the fight or help them fight the fight for them. So, one of the things, this may be slightly off point, but I think it's important now. And I guess it's a shout out to, state and national NADA, dealer associations. It's incumbent upon the associations to help preserve the value and thwart the intrusions by the OEMs. I'll use an example. When the real estate industry was challenged, when let's say the Century 21s and Coldwell Bankers and some of the Better Homes, all these national franchises were facing challenges by these startup FSBO companies, for sale by owner with reduced commissions of 2% to sell your house. The National Association of Realtors initiated a nationwide campaign, a public relations campaign, educating homeowners as to why they were better off using traditional franchised real estate brokers to sell their house. Same message to buyers, why brokers can help buyers acquire the house, obtain mortgage financing and home inspections and so forth. So it was a en masse campaign nationwide by the National Association of Realtors educating consumers. I think NADA should do the same. Now is the time to do something like that, educate consumers of the value of dealing with their local franchise dealer. I'm afraid that if that type of an initiative doesn't commence soon, then the value of dealerships will erode over the long term. So long answer to a brief question, I apologize, but I think buy-sell activity will continue to increase. Dealers will learn their options, whether to sell or engage in these long-term succession plans. But I do think the big privates and private equity groups and some publics will continue to solicit dealership sales across the country.
Okay, thank you. In line with your remarks and your response, it just seems that the larger groups are getting larger and the single point or the double point dealers are getting fewer and fewer. Do you, on into the future, do you see continued viability for the smaller dealerships, and do you have any special recommendations or strategies as to to assist in remaining viable as single points or very small operations?
Keep in mind, sure, although the big groups get the headlines, over 90% of the dealerships in this country are still, we call them mom and pops. I don't mean that literally, but up to 5 rooftops, 1 to 5 rooftops. That is the lion's share, over 90% of the network of dealers in this country. So it's not as though the small dealers are getting swallowed up and they're going to become extinct soon. They're still driving the market. That will change. I think to your point, or to the questioner's point, the larger groups will continue to buy the smaller groups. But will it end such that will they have 50% market share? Will they wind up, instead of having 5%, will they wind up with 10% or 15%? I don't think anyone knows the answer to that question. But if the person who asked that question is a smaller dealer, 1 to 5 rooftops, I don't think that there's a rush to the door by small dealers. I mean, I have plenty of single point clients that, this year will make 3 million plus in net profit. Why? So why change that? Are they going to be at a substantial disadvantage because they don't have the same buying power to deal with vendors? Well, yeah, I mean, that's always been the case. The bigger dealers can have economies of scale that the smaller ones don't, but it doesn't mean that the smaller dealers aren't making a return on investment that they're happy with. So there's no rush to exit the business by the smaller dealers. And I just recite that statistic so that they don't feel that they are slow at leaving, the franchise system. They are the lion's share of the dealers out there. So if I'm a single point dealer, I wouldn't feel any compunction to go out to keep the dealership going and instead turn around and try and sell it simply because smaller dealers are exiting. That's really not the case. It's a very, very slow process. There's still 17,000 rooftops out there. Many of them are owned. I think the number is something like 12,000 people own 17,000 dealerships. So, and most of those are owned by relatively small dealer operators. So I don't see, when you read the automotive news, it looks like, the big fish are swallowing the small fish on a daily basis, but it's a very slow process, and who knows where it'll end.
Okay. All right. Thank you. Another question. How do you see the proposed tax incentives impacting EV sales? I don't know if they're proposed or some of them, I don't know which have been included in the legislations already passed and which are proposed. But anyway, how do you see that impacting potential EV sales?
Well, it's interesting to see how, even Elon Musk kind of pushed back against that. The concern there is that the government is long-term trying to totally eviscerate the franchise dealer private ownership of vehicles. So first answer is I think subsidies are needed if EVs are expected to be in everyone's driveway because they're just too expensive right now. B, though, is what are the long-term implications of too much government subsidies of EVs? And that could be an erosion of rights of franchise dealers, because if the long-term, at least of this administration, is to control transportation, then I would look askance at it. And that's probably why Elon Musk objected to it. I mean, clearly his company would benefit from it. So I'm assuming he took a long-term view and said he's not a proponent of it because he may be a target of a government takeover. So on a practical level, subsidies would be needed because one of the points I made earlier are that EVs are too expensive. Keep in mind, one of the things that the Anderson economic study looked at was the general cost of ownership. But one of the things I didn't mention, which I brought up to Patrick Anderson myself, was that there's no factoring of the cost of insurance for EVs. EVs, as we know, are quiet, right? They don't emit any audible sounds. From an insurance liability standpoint, that's a risk. It's a product liability risk because pedestrians, people walking dogs, joggers aren't able to hear an electric vehicle traveling from 20 to 40 miles per hour. The insurance industry is not going to let that go. So if there are more injuries as a result of EVs, you can rest assured that the insurance industry is going to impose higher premiums on consumers. So it's not just subsidizing the cost of the vehicle, it's the increased cost. Oh, by the way, I don't think I even got to the bottom line on Patrick's report. His conclusion was that the cost of operating an EV will be for a mid-sized EV will be $1,554 a year, as compared to a mid-sized and mid-priced internal combustion engine vehicle would be $1,000. So there's a $500 disparity. And of course, what he does is he ascribes value to the time that dealers are going to be, take that back. He ascribes value to the time that consumers will spend trying to find a public charging station and then spending that time, whether it's 35 minutes or more based on how much time is spent online, and using let's say a $70,000 average annual salary, how much time value of money each consumer is going to spend as compared to spending 3 minutes at a gas station, 3 to 5 minutes at a gas station nowadays. So when you look at the $500 disparity and add on top of that the potential increased insurance premium that EV owners will have to pay, government subsidies will probably be necessary to level the playing field. But the long-term political implications of that I thought were interesting because Elon Musk himself rejected that as a threat to private ownership long-term into the future.
Okay, thank you. That appears to conclude the questions. We thank you, Len. We thank NYSADA partner and dealer advocate, Leonard Bellavia Blatt, for the excellent presentation. Very appreciative. We thank all of you for signing on. And if you have any follow-up questions, we'll certainly forward them to Mr. Bellavia. Recorded version of this presentation will be up on our NYSADA.com website by the late afternoon or mid-afternoon, certainly. And wish everyone to have a great day. Thank you. Thank you, Len.
Thank you.